Hello, my name is Patrick Burds. I am a commercial credit manager here at Mercantile Bank. I've been in banking for most of my career, and today I'm going to go over loan terms and structure with you to hopefully give you a better idea about how that works and the structure of that for both the bank side of things and on the customer side of things. So why is this important? This part of the process is important in looking at loans for the bank's perspective, in that it helps us mitigate our risks. Helps protect the bank and give us a good return, both on the interest rate side of things, for that risk. And all in all, it helps us consider how are we going to stay competitive within our market. And on the customer side of things, they don't want to be told what to do with their business, right? So it's less structure equals more flexibility for them, and less loans equals an easier time for them. So they're looking at this and saying, how is this going to make my life harder or less flexible when I'm operating my business? So we're going to go over a couple of typical loans in a financing package. The first one we're going to go over is a revolving line of credit. So think about a revolving line of credit as a credit card. You could borrow on it, you can go pay for your groceries, you can go pay, buy a new pair of jeans, something like that. And then you get your bill and you pay that off every month, or you make a portion of the payment every month. Well, a line of credit is similar for a business in that they're not using it for grocery shopping or anything like that, but they are going and buying a chunk of inventory for $100,000. And they might be able to pay off that once they sell that inventory, or they might have to sit on that inventory for a couple months. So there's a lot of movement that comes with that in the line of credit. So a lot of up and down balances. They'll also need to use it for payroll purposes. So if you've got a company where you have 100 employees and you have to make payroll every other week, that's a big chunk of money that needs to come out of your business. So it helps with that fluctuation in when your company may or may not have cash available for the expenses it needs. Between when you make products, you sell products, provide services to customers, well, they have payment terms. They may not pay you the day that you give them those things. They might pay you 30, 60, 90 days away from then. So you need to still operate your business in a timely manner for your other customers while you're waiting on payments from the other ones. So there's a cyclical nature that happens in the cash flow cycle for a business, and the revolving line of credit helps with that. So this is going to go up and down throughout the year. The amount. How do we determine the amount? Well, there's a lot of things that kind of can go into that. If you've got a company that has $1 million in sales, well, they probably don't need a $3 million line of credit, because those don't jive together, right? You don't need more money than you're going to have in sales going out the door. So a good gauge for a revolving line of credit is based off of the purpose, which is for your inventory, your accounts receivable, your customer payments coming in. So those are some good asset accounts that we can look at to give us a gauge for where the amount should be. So if your inventory is, say, $500,000 and your accounts receivable are at $1 million, you don't need $3 million again of a revolving line of credit. Maybe you need $1.5 million. So that gives you a good starting point there. But that amount can vary from a small business of $5,000 to a very large business that has hundreds of millions of dollars of revolving line of credit availability. The next part is rate. So typically, a rate for a revolving line of credit is going to be variable, meaning that it's going to change based off of what's going on in the market. Today, we're in a very volatile, rising interest rate market. The Fed is changing rates what seems to be every month or every quarter. So that has increased up to, right now, the Wall Street Journal Prime is at 5.5%. So that gives us the ability to change the rate with our borrowers too, based off of the risks in the marketplace, or that is perceived in the marketplace. There's other indexes that can be taken into account besides Wall Street Journal Prime. There's SOFR or LIBOR, which is the no longer being taken into consideration, but that's kind of the old equivalent. Next, we get into the term and the amortization. So typically for a revolving line of credit, there's not going to be an amortization, right? There's a cyclical nature. There's a pay up and pay down of the line of credit balance based off of when those cash inflows and outflows happen for the company. So we're not going to make them pay that amortization back, but there is going to be a term. And a typical term, I would say, is 12 months on a revolving line of credit. Now that can be longer, up to 5 years in some cases, or shorter, 3 to 6 months. And it all depends on the risk profile of the customer, the bank's feeling towards that risk profile, and what the customer needs, right? So if I only need it for 6 months, should we give them a 12-month term? Should we give them a 5-month term? They might not need it. But if I am asking for a 24-month term as a customer, the bank might feel comfortable doing that. And that gets into the competitive nature as well in the marketplace of selling it internally at the bank and selling it externally to the customer. The 12-month term gives us the opportunity to restructure the loan potentially, given changes in the customer's performance or the market performance conditions at that time. So in 12 months, we can look at it and say, borrower, did you perform how you said you were going to perform? Did you perform better than that? Does that give us an opportunity to reduce your rate or change some other factors in the loan structure that can make us more competitive so they don't go out to other banks, or it makes them more agreeable to using our bank in the longer term? If there's bad performance, do we need to increase our rate? Do we need to put in more covenants or higher fees or more guarantees or more collateral? Those are all things to take into consideration given our term. So that helps mitigate some of those things. Collateral. A collateral has to do a lot with the purpose of the loan. So what is the primary collateral for a revolving line of credit is going to be the working capital assets, right? So this is your working capital supporting up and down how your cash inflows and outflows are going. So typically our collateral for this is going to be inventory and accounts receivable assets. And how we get around that is this is equivalent to an all assets filing. And what an all assets filing does for us is effectively gives us the ability to take all assets as collateral that the business has outside of specifically titled equipment or vehicles or real estate. Anything that's really specific in nature that's large is typically going to have a title component to it or a serial number or something along those lines. This is a good catch-all for all those ancillary type of accounts that are not going to have those things. Getting into guarantees, this provides us with additional support and or collateral for a loan. So if we get a loan structure or a purpose that is for a business that's kind of teetering on this is a really great or this is just an okay, if it's just an okay type of business or loan, we want to have guarantees. And the guarantees are typically the owners saying that they stand behind their business and this loan. So if the business were to go through some hardships, the owners say, hey, I'm standing behind this. I'm willing to come to the table and support it too, and make the payments for the business if that happens. It's kind of a catch-22 in some instances because a business owner is going to get most of his income, his or her income, from the operations of the business. So if that's not doing well, typically the owner is not going to have a lot to provide either. But they might have some personal assets or something along those lines that they can help support the business debt with. It's a good psychological and economic tie to the performance of the company. And it is very typical for us to get these in most instances. However, again, given the competitive nature of banking and getting business, guarantees may or may not be needed, and that could be a good structural point where we would want to either provide them or not provide them in some situations. Getting into tracking and covenants. This is a way for the bank to kind of watch or monitor performance of the customer, typically from a financial statement perspective. For a tracking component, we need to get, for bigger businesses, they're going to have CPA prepared financials, audits, reviews. Smaller type of businesses, they're going to have tax returns, company prepared financial statements. Those are types of things that we need to get internally here at the bank so we can continue to monitor the performance of those companies to make sure that they're able to make these future payments in a timely manner. Also, going back to the guarantees, if we're going to get personal guarantees from the owners, we also want to get their personal tax returns, make sure that their personal matters are in order so that they can help support this if need be. Also get a personal financial statement from them. A personal financial statement for an owner is, think of it as a personal balance sheet. It's going to have their assets and their liabilities and be able to tell kind of how strong they are, if they've got a bunch of liquidity, some cash accounts, if they own their home, if they've got a lot of debt. So it helps provide a better picture that way. Also, thinking of tracking the amount of time in between when we need that information. Is it annual? Is it quarterly? Is it monthly? If it's annual, we probably have a pretty good feel about this company. If it's monthly, it's something we want to continue to monitor and be in front of because we might not feel that great about the situation going on. So that can play a factor in it as well. Covenants. So again, this gets into managing or monitoring the financial expectations. It gives the bank the ability to protect against a perceived risk that we see within the company. Also, if the company tells us that they need a line of credit for a new line of business they're doing, they're expanding, they're going to take sales from $1 million to $2 million, and they need to increase their line of credit from $500,000 to $750,000, we want to make sure that we put some factors in there that say, okay, great, you say you're going to do this, let's have covenants in place that say you're going to meet those expectations too. And if you don't, that gives us the ability to, if they don't meet those covenants, this loan term ends up being today or tomorrow. Then we can get in there and restructure because the perceived risk by the bank is much different if those things happen. Some typical covenants or financial covenants you might see are balance sheet focused, net worth, current ratio, debt to net worth, some ratios like that, or working capital, right? If this is tied to working capital, that's a good metric that we might want to look at for monitoring a revolving line of credit. Income statement, what do the sales look like? What's the profitability? Cash flow, you guys will get into cash flow at a different video or presentation. What's their debt service coverage? Is it in excess of what we want or is it below what we want? Some other types of things are distributions or owner's compensation coming in and out of the company. How does that impact their ability to repay us or to make the company stronger or weaker? Getting into fees. So this is probably one of the more competitive parts of the structure because it's really at the bank's discretion what these are going to be. I've seen it anywhere between waiving them completely and charging a flat fee. Typically, you're going to charge a flat fee for a revolving line of credit. So I say on average, you're looking at $500 to $1,000 in most cases. Again, that can be a good selling point internally and externally. Internally, we're going to want this as high as possible. The customer, though, is going to want that closer to zero. So that's where the selling feature of this whole process comes into play. And then you get into a prepayment penalty. So a prepayment penalty is when a loan will get paid off by another bank or a customer will pay off a loan early compared to what we think the term of our loan is going to be. Revolving line of credits typically don't have a prepayment penalty. So we'll get into that more so when we get over here to the term loan structure. So for term loans, think of these kind of, revolving line of credits are like credit cards. Term loans are like your auto loans or your home loans or home mortgages. They're typically for a single purpose, for like a fixed asset, such as real estate or equipment or vehicles. So you're going to have something where you're going to start out with a loan amount and then that's going to pay off over time, down to zero. With the loan amount, this can range, revolving lines of credit can range, same thing with term loans. They can go from anywhere between $5,000 to tens or hundreds of millions of dollars, depending on what the purpose is for. Typically, you'll see this amount be based on a percentage of whatever asset we are financing. So if you're buying a piece of equipment for, say, $100,000, typically we wouldn't give you a $100,000 loan for that. We want the owners to have some skin in the game to show that they're willing to invest in the same kind of asset that's hopefully going to provide value to their business. So we might do something like 75% loan to value or a 75% advance rate on $100,000 would be a $75,000 loan. So that can really vary, and also that can give us a competitive advantage, right? So if we're going to provide 100% financing, whereas the bank down the street might provide 85% financing, that owner is going to look at our financing as a much more advantageous product for them. Getting into the rate, again, we can go variable here, or it can be a fixed rate. So fixed rates are nice because it keeps your payments constant as an owner. However, that creates an element of risk for the bank. So there's the interest rate risk, right? So we talked about over here how if there's a variable rate and we're in a pretty volatile market right now for interest rates, that creates a lot of risk for the bank if we say, hey, we're going to give you a flat loan rate for the entire term of our debt. So typically, the longer the term of the loan, the higher the fixed rate is going to be for the bank to compensate for that risk. Getting into the term and amortization, this again has a lot to do with the purpose of your loan. So if you're looking at the term, that is the amount of time the bank is going to have the loan until we want to reassess the risk, right? So here it's 12 months. Amortization is the amount of time the loan's going to get paid out completely down to zero. So there are times when that term and am may or may not be equal. So for equipment, we're going to do something that's typically a 5-year term and a 5-year amortization. Now this can range dramatically depending on useful life of the equipment, right? So there's equipment that, like a car. If you buy a used car, what's the useful life of that used ar? Well, it depends on the condition and how many miles you put on it a year, how often you're maintaining it. So that can really depend on what type of equipment. And there's also, if you're looking at big manufacturing presses. Well, there's some manufacturing presses that were made in 1954 that are still making things today, but are past their useful life. However, we might still be able to use those as financing and collateral for our term loans. So it varies a lot depending on the type of equipment. Five-year term, 5-year amortization is pretty typical. This can get down to a two-year term, and it could even get up to as high as a 10-year amortization. Again, it depends on the asset type and the risk tolerance of the bank and the saleability of the customer. If you're talking about real estate, I would say a typical term and amortization is a 5-year term and a 20-year amortization. Again, useful life of real estate, typically a building is going to last a very long time. That land isn't going anywhere. Buildings are built to last. So a 5-year term is pretty typical. 20-year amortization, again, useful life. As improvements are made, that can get extended out, but this can go anywhere between 2 years and maybe even up to 10 years. And 20 years can go, I've seen it as low as 10 years in some instances, and all the way even out to 30 years for specialty type of projects that are multifamily, downtown high-rises that are going to be around in the community for a really long time. And again, this can be a preference of the owner too, right? So if you're saying that the bank's willing to go out 10 years on a piece of equipment, but the owner is debt averse, they don't want to have debt, they might be okay with doing it over 5 because they want to pay off that balance. Or if you want to get it in 5 as the bank, but the owner wants 10 because that makes their cash flow a lot easier, that's something you have to manage as well. Getting into the collateral, again, this is specific to the term, right? So you're going to have, instead of in all assets over here, you're going to have specific to what you're doing for the term loan. If we're giving equipment financing for trucks, we're going to say we're going to get these VIN vehicle numbered trucks. If we're going to say it's for this piece of equipment that's got a serial number, we're going to say this serial number. If it's a specific description, 2022 Model X Series 246 press, that's going to be our collateral. And in real estate, it's going to be the address of that piece of collateral. Guarantees, similar over here to term. Tracking covenant, very similar as well. So we won't go into those any further. The fees, this is where it gets into a little bit of difference. It can be a flat fee. Typically, these are based off of a % of our loan amount. So anywhere between 0.25% is a pretty typical fee. But I've also seen it go up to 1%. Again, it depends on how you're going to sell this internally at the bank and to the customer. If you're able to get a higher fee down here and maybe get a lower rate here, a customer might find that very agreeable, or maybe not. And then finally, getting into the prepayment here for the term, this is more of where you're going to see the prepayment penalty, mainly because of this fixed rate, right? So if we, as a bank, commit to a fixed rate, and we do that for a 5-year term, but the customer comes to us in year 3 and says, I want to pay you guys off because I don't need this piece of equipment anymore. Well, that's fine. However, we've committed to that fixed rate on our balance sheet for the next 5 years, or for the next 2 years that are remaining in that term. So we need to make sure that we're going to get compensated for that economic impact to the bank. The prepayment penalty, I've seen these run the gamut. It can be a tiered structure, it can be 1%, it can be 5%, 2%. It can be a really complex formula of a net present value of the lost income to the bank. Typically, a good range or a good measure of use is a 2% prepayment penalty. So hopefully that gave you a good overview of how we need to sell things internally at the bank and externally to the customers and areas to focus on. And hopefully you can put this to good use.